Hello, everyone. I'm Chris Kapches, President of Chestnut Park Real Estate, and I'm here to give you your July market report for Toronto and region. Very complicated month, this month of July, because there's three levels of activity in the marketplace that need to be analyzed in order to fully understand what's going on in the market. On a very kind of superficial basis, if we look at what's happening in July of 2023 and compare to what happened in July of 2022, you'll see a positive variance in almost every area. For example, there were 5,250 properties that were reported sold in July. That's almost an 8% improvement compared to the 4,870 properties that were reported sold in July of 2022. So superficially looks like the market is doing well. Similarly, with respect to the average sale price, in July, the average sale price came in at $1,118,000. Last year, it was $1,073,000, 4+% increase. Again, on the surface, it looks like the market is doing better in July of this year compared to July of last year. Unfortunately, that is, as I said, a kind of a superficial analysis, because at a different level, the market is actually doing quite poorly compared to generally markets in the past during this period. And especially if we look at what's happened over the last 4 months, beginning in April. As you'll see on the chart behind me, we have been decreasing in sales every month from April right through until July. So yes, we did 5,250 sales in July, and that was an improvement compared to July of last year. But July of last year, the market had plummeted to levels that we hadn't seen in over 2 decades. And the reason for that is because the bank last year had implemented 4 increases, taking us from 0.25% to 2.5% as the bank's benchmark rate. That had an immediate and very negative impact on the market, and we saw the market starting to plummet downwards. Hence the positive variance July of this year compared to July of last year. But if we look at what's happened over the last 4 months leading to July of this year, you'll see that we have decreased fairly dramatically in terms of the number of sales that have taken place in each of the months leading up to July. In May, you can see we had 8,987 sales, which was a good number for May, not only of this year, but May historically. What's happened since then is the bank has once again, in its wisdom, implemented 2 benchmark rate increases, taking us now to a 5% Bank of Canada rate. That has once again had a negative impact on the marketplace, and hence we see the fairly rapid decline in the number of sales. In fact, from May to July, sales have declined by 42%. That is a big number over a 3-year period. Somewhat surprisingly, the average sale price has not come down to the same degree as we see the number of sales. Average sale price over the same period is only off by about a percentage point. And the reason for that is because sellers are not yet being forced, either because of mortgage renewals or because of their personal circumstances, to get properties on the market in a way that there's a lot of choice for buyers, and buyers can be more aggressive in terms of what they're prepared to pay. And the third component of this marketplace is the sales that are taking place, ironically, in the most robust of ways. Like, for example, all the sales that took place, these 5,250 sales, all took place in just 17 days. From a historic perspective, anytime a market sees all properties sold in 17 days, that is a very fast, robust market, even though, as I just pointed out, the number of sales that are taking place are declining month after month, beginning in April, again, because of the Bank of Canada increasing its benchmark rate. But not only did they take place in 17 days, throughout the region, they sold for 102% of their asking price. That, again, is inconsistent with a declining market under normal circumstances. But these are not normal circumstances or a normal market that we find ourselves in. The reason for that is that there is still huge demand out there. And I've talked about this in previous market reports with the influx of immigration coming to southern Ontario. The number of people is far outdistancing the housing supply. So those people that are still in the market are paying good prices for the properties that are available, and they're buying very quickly. And as a result of that, we're seeing sale prices exceeding the list prices. In the City of Toronto, all properties that sold, including condominium apartments, came in at 103% of their asking price. And if we were to drill down into some of the other districts within the city, for example, the eastern districts, sales in those districts, particularly for semi-detached properties, came in at 113% of their asking price. So we have these three layers that are taking place year over year, which looks positive. Then we actually have the pattern that's developing since the Bank of Canada started increasing its benchmark rate, which shows that the market is declining and declining very rapidly. And yet within the market itself, there are pressures that are keeping average sale prices relatively high. And not only are they keeping them high, but in most cases, the sale price is exceeding the list price because of the huge demand. So what's responsible for this complex market that I've been discussing? Essentially, it's a question of affordability, or probably put more accurately, lack of affordability. Each time the Bank of Canada increases its benchmark rate, it either eliminates people from the marketplace or it forces buyers to downscale the price point at which they can buy a property. Unfortunately, it does eliminate some buyers, hence we're seeing the number of sales on a monthly basis starting in April decline, as they did in 2022 when the bank first started this very aggressive bank rate increase. So that is likely to continue as we go forward. We're praying, and I mean that, praying that the Bank of Canada does not once again increase its benchmark rate when it meets in September, because the impact would be devastating to the market. It already is devastating the market, but it would be even worse, because affordability is now the key component of what's happening in our marketplace, and the Bank of Canada has complete control over that part of the market. So I hope I've been able to convey the complexities of this market to you. I'm really looking forward to what's going to happen in the month of August. I think we're going to see more of what we saw in July, because there's going to be no bank movement at that time, but it'll be September that will be the key to what happens for the remainder of 2023, and I believe taking us deep into 2024. So until we do the August report, please stay well, and I look forward to presenting it to you at that time. Thank you.